Okay, hello everybody. Welcome to Korean Atlanta Mentorship, and in this video we're going to do another velocity banking review. And if this is your first time watching this channel or you haven't seen me talk about the same thing over and over again, this is my mortgage paid off under 3 years, actually 2 years and 9 months. And I actually don't tell most people that, believe it or not, because I feel like it's an unrelatable story. But I do like to talk about velocity banking, and sometimes when I talk about velocity banking, I don't know if this happens to you. I get like these random stares, and people blank out because it's just like something short circuited in their brain. Now, if you have people who are attentive to you, like you're blessed, right? Count your lucky stars, because to me, like I explain the strategy to real life people all the time, and they actually get it, believe it or not. Like they actually get it, and then they don't want to learn more. Like it's kind of weird. Like you think like, hey, here's some easy ways to kind of like, let's say, a lot of people have trouble losing weight. Like here's some easy ways to lose weight without thinking about it, and you understand the strategy and you want to apply it. That's how that's what I've seen many times, and we're going to talk about that today. But yeah, we're going to do another velocity banking review. And what is velocity banking? It's a debt payoff strategy using your line of credit as your main operating account. And basically, if you want to really like deconstruct it, it's just like throwing all of your money at debt with the help of a line of credit. In fact, before we get started, like I just want to show you this. I asked ChatGPT, it's like, why is it when I tell people about velocity banking, and I'm talking about real life, YouTube's a little bit different because people are specifically looking for the information that you're sharing on YouTube. But it's like, why is it when I talk about velocity banking, like people just give me a blank stare and act like they're not paying attention? And then ChatGPT has some really good answers. So let's go ahead and read it, right?
Blank stares and seeming inattention when discussing velocity banking often stem from a mix of surprise, confusion, and skepticism. Here are a few reasons why people may react this way and how you can address it. 1. It challenges their beliefs. Velocity banking often contradicts traditional views on debt and personal finance. When people hear about paying off debt rapidly in ways they never considered, it can feel overwhelming or even too good to be true. Solution: start with relatable examples and explain the why behind the strategy before jumping into the how. Acknowledge their feelings by saying, "This might sound unconventional, but let me break it down step by step." 2. Information overload. If you explain too much at once, especially with technical details, they may check out mentally because they can't keep up. Solution: simplify the presentation. Use analogies or short stories and pause often to check their understanding. 3. They're distracted. Some people might be genuinely interested but are preoccupied with other thoughts. Solution: start by asking questions to engage them, like, "Have you ever wondered how much interest you're actually paying on your mortgage?" 4. Lack of immediate relevance. If they don't feel it applies to their situation, they may dismiss it prematurely. Solution: tailor your message to their circumstances. For instance, if they have student loans or a mortgage, focus on examples that solve those specific problems. 5. Skepticism or trust issues. Some may think, "This sounds like a sales pitch," or "What's the catch?" Solution: be transparent and build trust by sharing your personal story, like how you paid off your mortgage in 2 years and 9 months, and emphasizing that it's not a quick fix scheme, but a disciplined strategy. By making your presentation more engaging, personalized, and digestible, you can turn those blank stares into curiosity and interest.
I like how it remembered when I typed in previous prompts. I typed in like, I paid off my mortgage in 2 years and 9 months. What percentage of people does that put me? And ChatGPT said like under 1% of mortgage holders paying off in 2 years and 9 months. And to be honest, like it doesn't even feel real because when I tell people about it, um, I just get blank stares and confusion. And I think I make it really easy because I'm one of the people who doesn't engage in information overload because I'm a little bit self-conscious about that. This is why as I'm like talking about velocity banking, I like to tell a lot of stories, anecdotes as well. But it's kind of hard to get people to get on the program just because I think it's a little bit too easy and it challenges their beliefs, right? I think that's like the number one um, uh, obstacle in like quote evangelizing, right? Financial evangelism, just because it's basically telling them that they're in the matrix and their whole like if you show someone this and they realize that they could have paid off debt ten years ago or like their entire debt low 10 to 15 years ago and they'd be like super rich right now, like how do you think they feel? Like it doesn't make them feel good. It's like did I I remember, okay, I remember when I explained to a kid like how a mortgage works, like 14 or 15 years old, and it's like, hey, this is how a mortgage works. And then uh, and then he was like, wow, like my mom wasted her life. That's what he literally told me. Like, what? Like you pay like 200% like on a or 100, like yeah, literally 200% of the purchase price on a 30-year mortgage, and he just like that was the words that came out of his mouth. My mom wasted her life. I mean, like that. It's hard. It was hard for me. I was just like, why are we doing this? But it's the Matrix, right? Talk about the red pill, blue pill. I know it's kind of a cliched. It's cliched nowadays to talk about that, but it's still the same. Like, do you think anybody else can do this? Well, it's kind of relatively easy if you have your debt paid off, right? So let's go ahead and do the strategy one more time. And do velocity banking. We only need two things. Number one here is a budget. So you just list a budget here: income, expenses, savings, expense breakdown. So what you do is you list all of your debts here and then the payments for those debts. And then the very last line, you could just combine your general expenses, approximately what you think would be like 3,000, 4,000. The non-negotiables like food, gas, insurance, the stuff that you always have to pay. Whereas every other line item has to be debt. It has to be debt. Okay, and so the goal is to pay off this debt with the help of a line of credit in the correct order, and we're going to need a line of credit, step two, as our main operating account. So what's a line of credit? A credit card is a line of credit. All a line of credit is a debt tool that's a two-way street. I can pay money back, I could borrow money back, or I could borrow money, I could pay it back. I could borrow money and pay it back. That's all a line of credit is. But there's other types of lines of credit that most people are not aware about. So for example, the home equity line of credit, HELOC, home equity line of credit. I have a $280,000 home equity line of credit. All that means is that I can go to the bank's website. I click a button on the bank's website, and then wablam, $280,000 dumped into my checking account potentially, right? And so I could just type up, like swipe up on my smartphone. The usually most banking apps have like the quick balance feature, meaning they just show, like you don't log into the banking app, but they just show like the numbers of the banking app. And so this is my quick swipe of the banking app. I just kind of swipe up, $267,000 available for me to use, and I can use it however I want. And so we're going to use this line of credit to help pay off debt. And this is a situation that I went over previously, but practice makes perfect. Just do it over and over again, okay? So the thing that we assume is that we make the same income, right? So if you're making this is really good money. Let's be honest, this is really good money. But you have all these expenses because of credit cards, two auto loans, a student loan, and a mortgage. Um, and you only have $1,200 left over, like $1,200 left over, that would make a lot of people ashamed, Like people are always having in their mind they should have 3 to 6 months of savings, and they're always like really nervous that they don't. But here's the thing, like that savings account, that's like poison, right? Like we don't want savings, okay? So I'm going to show you what I mean by that. So we're going to assume we have to start off with the same expenses, okay? Let's assume we start off with the same expenses, and then what we do is we move some of that debt into a line of credit. Okay, and so we're gonna have something called cash flow, which is income minus expenses, which starts out like kind of like savings, but remember our savings is going to be zero after every single month because what we're gonna do is move some debt into a line of credit, and then put our entire paycheck into a line of credit, and then take our expenses out. And so, what should your checking account look like? It should look like something like this, right? You start out at zero, money comes in your checking account, it ends at zero, it's taken out of your checking account. That's pretty much what your checking summary should be. That's what mine is pretty much every single month. I don't have anything in my checking or savings. It just comes in, it just goes out, and it's all going into the line of credit. Okay, so let me just go in here, and what we're going to do is we're going to have, assume that we have an 80,000, okay, 80,000 home equity line of credit, right? And I know some of you are out there like, this is so unrealistic. Who would give you $80,000, debt credit card like, instrument? Well, I got 280 right here. I got 280, okay? And in total, I have over $527,000 in lines of credit. And some of you, I've seen in the comments, like, why do you need that much? You know why you need that much? Because banks don't lend money to people who need it, so you always got to get it before you need it, right? And the reason why we build a lot of credit is for two reasons. Number one, okay, cash flow management. If you got, let's say you got rental properties and you got a $10,000 roof that you got to replace, okay, really easy to swipe if you got $527,000 in lines of credit. But if you only get like 15 to 20, and you're going to be hesitant about replacing that roof, right? Like your tenants can be like, man, my landlord's a slumlord because this roof needs replacement. You got a quote, you got a bid, and you're not going to swipe that card because that's 50% of your credit limit, right? But you want easy cash flow management. So when you got a huge credit limit and you need a new roof, swipe it and bam. Okay. So, reason number two, easy access to opportunities, right? So, let's say that you have a fix and flip that you need 40 grand down payment for. Well, you could just borrow from the credit lines if your bank allows you to do that, right? So, bring, I don't know, 40,000 as a down payment. Maybe pay the contractors with credit cards, right? And then profit 50,000 potentially after 3 to 6 months. I don't know, right? So that's an easy way to get into that real estate deal rather than having to do partnerships. Because I want to tell you something: the bank's money is the best money because it's drama-free money, right? The banks has infrastructure to track, to allow you to go to their website and track everything and just click a button and borrow the money, right? Do you think your friends and family have that infrastructure? No, they don't. That's why I don't borrow money from friends and family. I was like, whoa, the banks, credit unions, they got this whole infrastructure set up, and I'm going to take advantage of it because it's their main business, right? So, okay, so this is what we're going to do. We're going to use our line of credit as our main operating account, right? Line of credit. And so this is $80,000 limit, okay? $80,000 limit. And so what we're going to do is move some of that debt. This is just a debt transfer, not getting rid of it. We're just going to move some of that debt into the line of credit. And so start out with the credit cards. And as you can see here, I summed it all up. We have $76,000 of credit card debt. Okay, $76,000. So let's move some of this to the line of credit, okay? And then guess what happens by moving to 76,000? This goes to zero, 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 okay? And then now we see that their cash flows increased from 1200 to 3700. See how easy that was? That was so easy. It went from 1200 to 3700. And then what we do is we put our entire paycheck into the line of credit and then expenses out, and then after every single month it's 3700. Okay, so let's go ahead and do this. So this will be I2 plus 1. This is going to be next month's balance is the previous month's balance plus the previous month's interest minus whatever our cash flow is at the time, which is 3742.98. And then we got to calculate the interest, which is based on the average daily balance. So let's go ahead and look for that right here. So we're going to do average here. We're going to multiply it by 0.08 and then divide by 12. Okay. And then this is the interest calculated. And all you do is copy and paste to figure out when all of that debt pays off. Paycheck in, expenses out, paycheck in, expenses out. We got to pay some interest, so we're just adding it after every single month. And then we see that in 22 months, well, blam, paid off. Paid off. Do you see how simple that was? Like, I didn't have to think about it. It's just literally after you set it up, which is the hardest part, paycheck in, expenses out. Paycheck in, expenses out, right? And then you scroll down, and it's like, whoa, 22 months, less than 2 years, $76,000 of debt paid off. So 22 months, 76K of debt paid off, and I'm going to copy and paste. And then now we got these three loans right here: student, auto, and mortgage. So let's go to the loan calculator, see what the current balances are. Give me one moment. All right, so we got it here, and what we got to do, okay, is we just got to put the current month, okay, the current month, and this is 22 months, so we just type in 22 here, and then it's going to tell us what the current balance is, right? How much interest we paid. So look at all this. We paid a lot of interest, especially on that mortgage. And then what debts we can pay off. So we have this thing called the cash flow index. Think of it as a ranking system. So we want to pay out the ones that are usually really low in this number. Think of it as a ranking system. So what we're going to do is pay these two debts off. So C2 plus, whoopsie, G2 plus G3. So now that's 25 grand. So let me go ahead and copy this, and then we're going to move that into the line of credit. So almost done here. Copy values, and then let's go ahead and add that. So it's 25368.75. Okay, so we move those two debts with the low cash flow indexes to that line of credit, and let me go ahead and make this font red, right? Font red. Okay, so now we've done that, and guess what happens to the cash flow here? 0, 0. Okay, 0, 0. And then this is like 4,500, right? And so now we're gonna do this 4517.16, and then I'm gonna copy and paste our new cash flow, and then in 28 months those two car loans are gone. See how easy that was? So we took 1, 2, 3, 4, 5, about 6 months to pay off two car loans. Oh, that was really easy. So now the next one is the student loan. So what are we at? 20, was it 28 months? Yeah, 28 months. All right. So 28 months equals 76 plus 20 plus 17, and 28 months for 113K. So 28 months, 113K, 113K. And then we got the student loan here, okay? The student loan. So let's take a look at the balance of the student loan at 28 months. So this would be 28, 28. And then here we see that the cash flow index is about 73. So what does that mean? That if we pay it off, we don't get really that much bang for our buck, because we're paying off 26 grand to only get $360 back. But I'd say because the balance is relatively low, if we move it into line of credit, we're probably going to pay a little bit more than we have to, unless we do what we call the chunking method, which is just splitting up your loan into paying off the principal into pieces. But I feel okay with this moving it to line of credit. It's not going to be that bad. All right, so now let's go ahead and move the student loan here. So if we move the student loan, here, so this is plus 26989.90, I believe. Okay. Now what happens to our cash flow? Well, our cash flow increases by this 300. So now this goes to 0 for the student loan. And then, right now it's 4,885 and 19 cents. So let's go back here. Okay. So let's just do this. Let's do a formula right here. And then, so now this is going to be 4885.19, 4885.19. All right, so that's our new cash flow. And then I just got to copy and paste and see it. Whoa, student loan paid off pretty quick. Okay, so that's going to be 34 months. 34 months. And how much is it? So that's I believe that's 146. So I think it's 33K. Yeah, 146K. And then the last thing is the mortgage, right? So basically, at 34 months, what's the balance of the mortgage? And then we'll just do it right here. And then you see that it's 281,000. Should we move this into a line of credit? Probably not. Well, the whole thing time out. But if you want to attack it in pieces, even with the interest rate difference, the interest rate difference is kind of minimal in its effect. Okay, so this is what we do, something called chunking, which is just moving a part of the loan into the line of credit. Just this very small part, kind of similar to your paycheck. The most important part of this isn't the chunking amount, It's your cash flow number. And this is why it's very important to pay off this mortgage last, because in order to get the $1,200 of cash flow, we have to pay hundreds of thousands of dollars. And no sane person would give $200,000 or $300,000 to somebody to only get $1,200 back, unless they were in it for the long run. Okay, so we got that, right? And now what we got to do is just quote chunk it, right? Just split the loan into pieces. And you can see here that we paid off about 20K, a little bit less than 20K. We'll say like 19.3K of the loan. But let's just do this. If we move 19.3 into the line of credit, so we'll just do this plus 19,300. How long does it pay? Oh, I put an extra zero. How long does it take to pay off that 19,300? Well, let's do that. And it's just like 4 months. Bam. So what took us 34 months, we literally did in 4 months. And we just rinse and repeat the process over and over again. Now let me pull out the velocity banking calculator to figure out how long it'll take for us to pay it off more accurately. So give me one moment. Okay, so here we are with the velocity banking calculator provided by Renatus. And so just a quick plug, I actually, one of the ways that I make money off of this channel, if you want to support it, and not only support me, but support yourself, is I sell educational products. So this is where I originally learned velocity banking from, Renatus, and Renatus allows people, like their own students or members, to resell and redistribute the education. So this is just kind of a channel to kind of spread the word about Renatus, and they created this cool calculator right here. If you're interested, go ahead and click the Google form link below. Now, I know that things cost money, right? But here's the thing. Would you pay a couple of grand to potentially save hundreds of thousands of dollars and not only learn about just velocity banking, but also wealth building strategies? This is why I paid, right? Because when I pay attention. Okay. Now enough of that. So let me get to this right here. So if I just put in the information right here, it's 4.1 years takes me. 4.1 years, and look how little interest I pay. Whereas if I do the whole thing, replace it with the first lien HELOC that I hear on the internets, look how much more interest we pay. So it's like 56 grand. So I don't know about you. Would you rather pay 56 grand or 19 grand? I pay 19 grand and 4.1 years. So there's no reason to do a first lien HELOC or a first lien replacement. I think it's just it's baloney, or what the former or the president, who's kind of on his way out, he was just like, it's malarkey, and it is malarkey. All right, so let's just go ahead and type that in right here, and this is now 0, and it's going to be paid off in about 4.1 years, so 34 divided by 12, 12 plus 4.1, and ooh, all of our debt is paid off in 6.9 years, debt free. And how much debt do we have? Almost half a million. Well, about four. Well, not half a million, but almost $446,000 of total debt. And look how easy that was, right? I did it in like, how many minutes are we in? We're in 23 minutes. So I paid off in $446,000 of debt in less than 30 minutes. See how easy that was? And then I know when I explain it to most people, they'll even understand it, but they'll just give me blank stares because people got the poker face going on. And, kids are always honest usually, so they'll just blurt out stuff that most adults find it hard to kind of say or admit. But man, told the son's like, man, my mom wasted her life. I literally can't make this up. Just like I can't make up that I paid off my mortgage under 3 years, right? And for most people, this is why they won't click on the video, because what do they relate with? Paying off $10,000 credit card debt in 6 months, right? And very few people that and I'm not saying that you can't get one, but very few people that will get a huge line of credit. And to be honest, I've seen people with bigger lines of credit just based on where they live, right? You live in California, you buy at the right time, and you can get a huge line of credit because California properties appreciate like skyrocketing fuel. All right. Well, that's it for today, folks. Have a happy Thursday. And let me know what your experiences are. Explain the velocity banking strategy. Maybe you're blessed and you have people who listen to you, but in my real life, people just give me blank stares. So, all right. Well, have a great day, everybody, and we will speak next time. This is Korean Atlanta Mentorship.